Maverick. Noun, unusual person. A visionary, leader, go-getter, an independent thinker. They see the vision for their life and pull that future towards them with an unyielding belief that things can and must be better. They achieve what most won't. Innovative, influential, daring, and direct, with a remarkably high tolerance for taking calculated risk. A foe to the status quo. This is Passive Real Estate Investing with Mavericks. Your host, Neil Timmins, has been involved with over $300 million in real estate transactions. He's a published author, commercial property investor, and real estate syndicator. This show is for those who want to learn how to earn passive income through real estate investing. Now, here's your host, Neil Timmins.
It's Financial Freedom Friday. I'm here with Ava Baukamp, and we're going to uncover sale leasebacks.
Hey Mavericks, this is Ava Baukamp, and this episode of Passive Real Estate Investing with Mavericks is brought to you by Legacy Impact Investors. We are an industrial investment firm located in cash flow country, the Midwest. We strive to shield off risk and beat inflation, all while producing predictable cash flow. We curate real estate investment opportunities for busy professionals and other real estate investors seeking passive income. To learn more about what we do and connect with me, go to www.legacyimpactinvestors.com.
Welcome to Passive Real Estate Investing with Mavericks, where we provide you actionable steps for you to grow your passive income and become job optional. During this episode, Financial Freedom Friday, we're going to be uncovering sale leasebacks. For those of you who are new, I'm your host, Neil Timmins. I love passive income from real estate. Now, before I have Ava Baukamp join us today for Financial Freedom Friday, I want to make a request that at any point, like what you hear, well, give us a thumbs up. Be certain to subscribe to the show. Never miss a valuable episode. If you love what you hear, give us a written review. Plus, be certain to look at the description of this episode. We packed it with thousands of dollars in free resources. It's another Financial Freedom Friday. I've got Ava Baukamp here with me today, and we're going to be uncovering sale leasebacks. Ava, how are you?
I'm doing excellent. It's been a productive day so far, so that's always a win.
That's terrific. So let's talk about sale leasebacks. What are they? Who are the players involved? There's a whole lot of things we can uncover.
Yes. Before we get to that, I have a question, and it relates to sale leasebacks, and this will all tie together. So let's say you're driving down the street, or I'm driving down the street, and you see a Starbucks and a Walgreens and a Dollar Tree. They're great properties. They're all lined up next to each other. And these properties all probably have one thing in common that you may not be aware of. And the answer to that question is they're probably all sale leaseback properties. And so sale leasebacks are all around us. We just probably haven't identified them. So Neil, why don't you tell us what even is a sale leaseback?
Yeah. So what's a sale leaseback? It's exactly what it sounds like. A property owner, in this case, make up a name. How about Chick-fil-A? One of our personal favorites. The two of us who love to dine at Chick-fil-A. Makes for a wonderful lunch. All right. So Chick-fil-A, they have constructed this property. They own the property. They sell the property. So that's the sale part of this, right? They sell the property to an investor. And what do they do in return? They lease it back. They sign a lease for a defined period of time, defined dollar amounts, the whole kit and caboodle. They lease that property back. It's just exactly what it sounds like. It's not more complicated than that.
Yep. And all kinds of companies do sale leasebacks. FedEx, Taco Bell, Walgreens, Arby's, Bank of America, AT&T, Sheetz, Bass Pro, BP, Bridgestone, Wawa, Starbucks, 7-Eleven, CVS, Valvoline, Aldi, all of these big companies do sale leasebacks. And it's something that, like I said, it's all around us. And a lot of people just simply aren't aware of it.
Yeah, no, you're absolutely right. In our backyard, how about that? Come and go. Lots of sale leasebacks. You're totally right. And there's a lot of benefits, underlying benefits to both parties, the investors certainly. But, the question for most people, if they're not intimately familiar with these sale leasebacks, is why would a company even do that? Right? Why would a company even do that? And the big reason a company would do this is because they make more money investing in their operations. Right? So 7-Eleven makes more money slinging Slurpees than they do owning the real estate. And what they can do is, by a result of constructing their 7-Eleven, putting it in place, signing a lease, they earn some money when they sell it to us and the investors in the marketplace who would buy that. And they put that money back into operations and continue investing in what they do better than other people do, is owning and operating their 7-Elevens and leasing that real estate.
It really is a win-win for both parties because, like you said, for that business, they are really good at what they do. They've got, in a lot of cases, national systems, national teams. They've got their business down to a science. And so they know with a lot of certainty that if they open up this new store in this location, that they're going to produce a certain amount of return. And it's better for them to invest in that system that they've already established than to try out being a landlord, being a real estate owner and operator, which then creates an opportunity for investors like us and for passive investors to participate in the stability that those kinds of leases provide, while at the same time allowing those businesses to expand and grow and really unlock that equity, unlock the capital that they've locked up into the real estate that really they want to invest back into their business.
No doubt about that. Another benefit is they sign long-term leases. In many cases, it's 10 years on the primary lease plus a bunch of options. In many cases with options, before you know it, you could be out 20 to 30 years when you add up all the primary lease plus the options to have that stability. Oftentimes they're in, wonderful locations and tremendous buildings. It's not just limited, of course, to a bunch of the names that all of us know because we drive by all these retail places. A tremendous amount of these take place in the industrial market, which we heavily participate in. And people can unlock the capital so they can invest in their expanding operations, invest in inventory, whatever their operations happen to be. Another benefit to these folks, of course, is they make more money. Yes, as I've stated, make more money investing in their operations, and they sign a lease. That lease becomes fully tax deductible, right? You can write off the expenses with a lease versus the ownership of property. You cannot. Yes, you can write off the interest costs associated with it, but when you're paying down equity, that's not deductible, which means they can unleash some of the debt equity, the cash they have tied up into a property to invest in their operations. They can avoid new debt. A lot of companies want to not have debt on their balance sheet. It strengthens their financial position. And they can expand operations. They're going to reduce some of their operating risks. And for some people, it's an exit planning tool. I'm thinking, of course, into the industrial side where you may have somebody who's been in business for, years and years, decades in many cases, a family business, somebody who has their own business, not a publicly traded property. It can line up very well with them from an exit planning perspective to take place and separate that real estate from the operations so that, oftentimes it becomes, at a net basis, they can make more money by separating those two.
Yeah, and absolutely. They're looking towards the future. They're saying, I want to be out of this in 10 years or so, out of my business. Maybe they want to sell their business. It might be a wise move for them to unload that property, or maybe they have multiple properties. And it might be an easier move for them to sell the business separate from the real estate than it would be to try to find a buyer who's going to be able to float all of those component parts at once. And so it can make that exit planning just a lot simpler for someone and give them a long runway to make that happen.
Ava, let's talk about how one goes about evaluating these sale leaseback opportunities, or maybe some of the factors to consider when they're going down there. There's probably 4 or 5 or 6 really big ones that stick out in my mind. The biggest one for me is, who's the tenant? Who is the tenant? What is their credit worthiness? It's one thing if it's Wawa, 7-Eleven, Chick-fil-A, some of the major industrial players out in the marketplace. I mean, people who operate or occupy industrial spaces, publicly traded companies come to mind. Manitowoc comes to mind, a number of them. Versus, it's Jim Bob's Burgers, right? Those are different tenants, different credit worthiness, and the result, they end up with a very different lease situation. So who is that tenant? What's their likelihood, their probability to pay on an ongoing basis? In
addition to that, who's the tenant? But then also, what's that building worth with the tenant? And a separate question, what is that building worth without the tenant? If they leave, if they aren't able to pay and they have to be removed from the property, is it going to be easy to fill up that space? Is it in a good enough location that you're going to be able to scoop up a new tenant for that property pretty easily? It's very crucial to consider, yes, this might be a strong tenant, but if they leave, after 5 to 7 years, is this going to be an asset that's easy for us to reposition and refill? Or is there too much risk involved in just the building itself and the kind of property it is that it's not worth it, even if currently it's occupied by a pretty solid tenant?
Yeah, the property condition comes to mind, and there's two paths I go down. What's the property condition? Again, Chick-fil-A is an example of one. Exactly what it's going to look like, how they're going to maintain it. All of these are, end up in typically absolute or triple net leases. If something goes wrong, they're the ones who fix everything or remodel it all. They just handle it all. Versus, the property condition when you're thinking of perhaps an industrial property that's more of a box. And to your point, Ava, who's going back in that box if they're not there? So I give more consideration to the property condition. What's that look like? How old's that roof? What are the conditions like in that type of property? And how's it going to be maintained on an ongoing basis? Because I really want to have an understanding of that property and a box to be very well maintained. Versus Chick-fil-A, for example, I'm a little less concerned because I think somebody's got to come in, if Chick-fil-A, whatever's ever to leave, somebody's got to come in and probably scrape that building and start anew. You've got tremendous real estate as a result of that, the ground. They're probably going to brand new. They're probably going to put something else there. So depending which path you go down, I'm evaluating that property condition just a little differently.
Yeah. And I think just to wrap up this section of things that we consider for these sale leasebacks, on the tail end of condition is also location. So you think about a tenant like a Starbucks, they're going to look for property locations with lots of traffic, very high visibility, and they're usually locations that are very desirable just because, they have a demand for a lot of foot traffic and a lot of vehicle traffic. And so they're usually in great spots, great locations. But for an industrial tenant, that's also something you need to consider. What's the location? How easy is it to access? Do I have two-way street access? Am I on a one-way? Am I close to a railroad? Am I at, the last couple of miles of some sort of distribution infrastructure? Just some of those location considerations can really depend on what kind of property it is. What
city am I in and what county am I in? Right, you could go a handful of blocks one direction or another, and you might find yourself into a spot where the tax structure for that city or that county is different. And some of us would think, well, you know what? If it's a triple net lease, the tenant pays all the taxes, the insurance, everything associated with that property, which is 100% true. But if you find yourself in a spot where taxes are very high versus literally a handful of blocks a different direction, they're only going to pay so much at the end of the day for the lease plus all the taxes, the insurance, everything associated with that property. So oftentimes we can find ourselves in the right city and the right county. Many times we as landlords can get more for our property, right? Whoever this tenant happens to be, the ownership can get more for that property as a result of being in the right location, because the all-in number for the tenant may look very different than if it did in a different city, in a different county, where the taxes may be higher.
Mm-hmm. So sale leasebacks, it's technical, but not a hard concept to wrap our minds around. Can you tie this back for us, what this actually means from a passive investor perspective? Cool, Neil, sale leasebacks sounds like a cool subject. What does it actually mean for me if I'm looking at investing my money into a deal? What kinds of things should I be thinking about? what are the benefits to me as a passive investor of looking at putting my money in something like a sale leaseback transaction?
The biggest single benefit, cash flow. Stable, predictable cash flow. And oftentimes, you've got a variation, but when you're underwriting, you've got the correct tenant. You've got a really good tenant who's going to be there a long period of time. It's very stable cash flow. It's a wonderful for that perspective.
Yeah. So some good questions to ask would be something like, how long is the lease? Mm-hmm. What are the options? What are their options to extend? What are the rent increases over the period of their lease? Those would be some good questions to ask to kind of fish out what that lease structure looks like.
Well, what that lease structure looks like. And then, it's as easy as pulling up a map. Get on Google Maps. Where are they? What is that location? If you're in a retail spot, you want to be on the corner of Main and Main, if you will. And if you're an industrial spot, you'd like to be in an industrial hub where there's other industrial buildings and action and activity and proximity interstate. You want to see all that taking place. But strong, stable cash flow. These are wonderful. Almost liken these, if you will, to like a bond, right? Stable, predictable cash flow. Oftentimes without the volatility of a bond, but stable and predictable.
Yeah, you're going to have, it's not something like ground up development where you've got, potential for very high rewards, but that comes with a lot of risk. And so you have to ask yourself as an investor, what's important to me? Am I looking for, just kind of gambling my money on this? Let's see if this development works out in 10 years from now, or am I more concerned with placing my money in a more secure vehicle, like a sale leaseback, where I know that tenant's in there for 10 years. They're paying every single month. They've got 2% rental increases scheduled out over those 10 years. That's a much more stable kind of vehicle than something like.
Right. I love what you just described there, two ends of the spectrum. And you, one as an investor, needs to know where they fall and gravitate towards the opportunities that align them with yourself, with the goals and your risk tolerance. What a great conversation. I love sale leasebacks, Ava. These are so much, what tremendous transactions. And I know we routinely get involved in these. So it's a lot of fun. I appreciate you being here. It's a great conversation, and I'll see you next Friday.
Thanks.
To our listeners, pat yourself on the back. You guys have made it to the end of the show, and most people never finish what they start. If you receive value from today's show, be sure to share it on LinkedIn, your Facebook page, or your social media platform of choice. Subscribe to never miss a valuable episode in the future. And if you found value in today's episode, give us a thumbs up with a positive review. If there's a particular topic you'd like to hear about, well, I want to hear from you. Shoot me a message on LinkedIn. The link to my profile is below in the show notes. You can connect with me there for more